challenged some of the current directors on the board and, looked for ouster of Mr. Jawahar Goel. Since then, it's shot up to almost 20 bucks. Anyway, CDSL is having a fantastic start, about 4 to 5% higher. In terms of other stocks, Arvind, Smart Spaces, you just heard the management talk about the equity infusion, so 2.5% up over there. Zomato, I guess Prakash's argument is the one that the market's going with, that there is more focus on the business. You're not diluting too much by trying to deliver everything. Maybe that's the reading that the market's taken. It's doing well. The spike in oil price is working well for an oil India, by the way. And if you expected red on tire stocks or on paint stocks, that's not how the correlation is playing out on a one-to-one basis, really. In fact, tires are doing pretty okay. MRFC, I remember rubber prices have fallen quite a bit. So that's become the added force over there, and just very mild red on a Kansai Nerolac. I mean, there's no major decline because of the spike in oil prices. So that's how it's shaping up. Other than that, largely holding out okay. Anuj, on the index, that first sort of big cut came in 40, 50 points down. Now it seems to be stabilizing. But banks, once again, the problem to begin with?
I think the banks are clearly the problem, and not just banks, there are a couple of other stocks as well, Surbhi, which are showing you some signs of fatigue. Reliance, for example, also some of the erstwhile leaders like an India Mart in the broader market, Info Edge. So the market perhaps in a bit of a mood to take some money home, I guess. Keep in mind, it's been a buy on dips market, so it'll be interesting to see if at any point the dip gets bought or not. Let me ask that to Prakash, or to Mitessh rather. Mitessh, is this a dip that you would buy, or a slightly bigger one?
Not yet, Anuj. I think 17,200 is my key support area. So maybe another 50 points, 60 points lower you would want to explore along.
Okay, Mitessh, thanks a lot for joining us. Have a good trading day. Atul Suri is joining us now, CEO at Marathon Trends PMS. Atul, good morning. Thanks for joining us on the show. So it's been a one-way rally for the Nifty, Atul, and the market keeps finding new leaders. Right. Your thoughts on just how much more for this run? I mean, of course, as a trader, perhaps you don't want to question that, but as an analyst, what are you seeing?
Absolutely, Anuj. Very, very right. Everyone you meet, the question is that when is the market going to fall? How much more is it going to run? Everyone has total disbelief. See, the Nifty's moved from 7,500 to around 17,400. So we've had about 130% move in the index in the last 18 months. And everyone is shocked. Everyone is in disbelief. So we really decided to do some research and look back that whenever markets have had crashes, we had a big fall in the COVID times, the market went down 40%. So whenever market has shown such behavior, what is a typical price behavior? What's this first move? What's the quantum? What's the time frame? So the recent ones that come to our memory, we have good data, is the 2000. That was the IT crash. The market fell about 50% in 2000. And then in 2003, we had a vertical move in the market. The market had this, there's almost like a spring that gets compressed, is released. And you have this kind of vertical move, which we are experiencing right now. So in 2003, the market moved 120% in 9 months. So the fact is that today we are at 130% in about 18 months is not something that's new. In fact, we moved 120% in about 9 months in 2003. So we've had such moves in the past. Then you go back to the next big fall in 2008. That was the financial market crisis. And you'll realize that in 2009, again, you had similar price moves. The market moved 180% in 21 months. So the fact is that this first stage of the bull market, which is what I define this move, is very often a very big surprise. And to try to pick a top or try to quantify it is a big fallacy. So for us personally, we think that, yes, the markets have run up. Yes, it may be risky to some short-term corrections, but it's not a time to really go out and take a cash call, because we have seen in the past that markets tend to have these blowout moves after very big crashes. And so far we are at 130%, we've taken 18 months. And even when we went and analyzed that, okay, we cannot continue this pace. We know that forever. The next year cannot replicate what we had last year. But even after that, when markets went into consolidation phases, after running very fast, you need to catch your breath. It was very, very rewarding for investors. So again, no attempt to find a top, no attempt to stay in cash, because history has shown us that we have seen similar moves in the past. Corrections will come, but I think there will be opportunities. And even in a sideways or a consolidated market, I think there'll be a lot of wealth creation opportunities emerge.
Okay, so that's a fairly optimistic view there. This is not the time to raise cash levels despite the higher moves we've seen in the market, and every correction will be an opportunity. Got that? Atul, hi, morning. But just trying to play the devil's advocate here. It's been 5 days running now that the US markets have been under pressure. There is, of course, some caution as far as the taper issues are concerned. Any red flags with respect to the global markets that an Indian investor should be aware of?
Absolutely right, Sonia. In the US, obviously, we've had a couple of days of correction, no doubt about it. But one big area in the US that is showing a bit of divergence, a bit of a red flag for me, is the divergence between the Dow Transportation and the Dow Jones Industrial Average. Now, for someone, there's a theory called the Dow Jones. It's a very, very popular theory. And in that, what it says that the Dow Industrials and Dow Transportation should go together for a sustainable bull market. What we are seeing is that transportation is correcting, though the industrials is holding out. So that becomes an area of divergence. But the thought process that is coming through is that transportations typically as an index is losing importance simply because a lot of delivery of goods and services happening through the digital way. So that's how people are trying to sort of look at this divergence that is playing out. But that is one area that globally that is an area of concern, is the divergence between the Dow Industrials and Transportations. The second area which I think and which really affects India is the performance of the emerging market basket. For whatever it is in the last 4 to 5 months, the index per se has not done well. India has been a rank outperformer in the EM basket. And thanks to China, emerging markets as an asset class have not done much. And that's why you'll find that the FI flows to India stop and start. 1 week they come positive, 1 week they come negative. And the major push to our markets is domestic liquidity, domestic investors. So as I said, there are no red flags. The breadth is generally good globally. Most global markets are doing well. China is an area of concern, and that's putting pressure on EM. And if that gets resolved, I think that the market could get another stimulus. Otherwise, I think globally, equities as an asset class is holding out pretty well.
Atul, good morning. So, if the market is going to keep defying all the disbelief and keep rising higher, the question is, who will hold the flag high? We were just having conversations around Reliance, whether that has serious momentum that can last the next couple of weeks or months, or will it be a return to quality? We were discussing FMCG stocks earlier, and they've been really doing very well. So what do you think? Who will be the flag bearer?
So, every bull market throws up new leadership. The last bull market from 2015 to 2020, I think was very, very representative of banks. The private sector banks really led it. And today, if you look at it, it simply seems to be the most overweight position with most funds, etc. But what I have really seen in this rally that has happened, that leadership is changing. So what we do is we take the NSE 500 stocks and divide them sector-wise. Unfortunately, the sectorial indices that we have, the NSE or the BSE has created, are not really very accurate. So what we do is we classify them on sectors and try to look for market breadth. So market breadth is nothing that it's not 1 or 2 stocks that should skew the index. But when you have a very broad-based participation in a sector, you realize that that is where leadership is. And clearly, when we do this work for the week that's ended, IT really, really stands out. Almost 50% of the stocks in the BSE, in the NSE 500, which are IT, are at lifetime highs. So that really shows that the breadth in IT is not just large cap, it's also happening in mid cap. So clearly, the mantle of leadership is moved away from banking towards IT. I think healthcare and pharma is another sector. Again, not shown in the Nifty Pharma Index because there you have weightages of Lupin and Sun Pharma, which are not doing much. But if you see broadly, a lot of pharma and healthcare stocks, the hospital stocks are doing very well. So you find a very good move there. Metals, another space, another sector that's been a dog, is still holding out very well. So the leadership in the market has moved away from banking and has moved towards IT, it's moved to pharma, healthcare. I think consumption, your whole FMCG basket is showing excellent breadth. Breadth is a very good indicator, we realize, to understand the real strength in the market. The giving away of breadth very often is where you pick early signs of weakness. And that's something that we are seeing strength in these sectors. Weakness that really comes in is more in the case of, you find autos. Autos is definitely one sector that is showing immense weakness in terms of market breadth. You see sectors like media, again, pretty bombed out and beaten. They have one or two good days, but really they are not able to sustain. So sum it up, we see the mantle or the torch moving away from banks towards IT, towards consumption. Another sector that we think has an amazing breadth and is really sort of burning the rubber is your specialty chemicals.
Oh,
it's a very big overweight position in our portfolio. And we think that that is where, again, it will not be caught by indices. There are no sector indices for it. But if you look at the movement that is happening across sector, you'll realize that this is a very big trend that is playing out. So leadership is changing, and our attempt is to be with the new leaders that are emerging.
Oh, absolutely. Look at SRF once again making a move to all-time high. So specialty chemicals has done well. Now, Atul, you spoke about metals. Now I have a question on this commodity super cycle, which a lot of people are talking about, because I remember even in the previous bull market, the sharpest correction that we had was on account of inflation concerns and on account of this big rally in commodities. But two-part question, your thoughts on this commodity rally itself, how much more to go, and does that pose a bit of a risk going by the historical evidence?
I think that's a very valid question, Anuj, because if when I wake up in the morning, as I said, I don't wake up and look at the Dow. I look at bond yields in the US and look at how the CRB index is doing. So, a very big measure, a very good measure of commodity prices is the CRB index. The CRB index is today placed around 220. And mind you that it has been declining since 2008. It has had almost a decadal underperformance, commodities as an asset class, and they have turned around. It had reached about 100. Today it's around 220, so they've almost up 120%. But I think that the CRB index looks good to around 300. So from here also, I think that there can be a 35% kind of move that will happen in the CRB index. What that does is definitely puts a little bit of pressure on the inflation side. And if inflation spikes, in the US, there is this very big discussion. And I think that's the most critical point, the mood point, the single area which will determine where markets are heading, is that whole inflation, is it transitionary, which is what the Fed believes, and which is probably what the bond market believes, or is it structural, which is what the CRB index is saying. So I feel that there is a conflict. And as I said, for me, if there is a single point that I'm looking at with the microscope, is not what happens in China or how EMs are placing out, is actually this. Because if inflation tends to be structural in nature, I feel that the whole Fed's easy monetary policy could start tightening much faster than people expect. And this is what could lead to a spike in bond yields. And I think that is the big red flag or the big area that could spoil the party for equities. So all in all, we are not there yet, but clearly that is the area that one should focus on, because that is going to be what's going to drive liquidity. The big elephant in the room is the liquidity, is the Fed. And what can spoil the party is if inflation really is structural in nature. And for that, I look at a very simple thing, is I look at the US bond yields. I think that's a very important market. It's a very intelligent market. US 10-year bond yields around 1.35. Obviously, they will keep moving, 125, 150. But I think the previous recent high was, I think, 1.74. If it goes beyond that, I think that's when equities as an asset class globally can get spooked. And that, I think, is the single risk to the market. Inflation, tightening of monetary policy, which will get reflected in bond yields above 1.74, is one specific point that I would look at as something that can sour the party.
All right, Atul, we'll leave it at that. Thank you so much for joining us, and it was a pleasure speaking with you.
Thank you.
So there is a bit of pressure in the markets right now. Thanks a lot.